Bean asks a question, how are the DAO members going to get paid for the free work post-exploit?
Well, that's ultimately up to the DAO to decide. So Beanstalk Farms, we've been talking to some of the members of Beanstalk Farms about this, and the expectation is that heading into Q3, which I guess is starting almost immediately, the protocol is still not on, so there's really no budget to be had for contributors. But the hope is that shortly after the protocol is back on, the DAO would vote to both fund continuous development of the protocol and potentially also retroactively pay some contributors for their work in the time that the protocol was off and no one's been paid. So that remains a very open question, and one that the DAO will have to collectively decide on the best way to move forward to ensure that the protocol is developed by a high quality set of contributors that feel appreciated. But to date, there hasn't been any friction between Beanstalk Farms and the DAO and Beansprout and the DAO, and no reason to expect that to change at this point, given how amazing some of the contributors have been.
Yes, and I'll echo or say as well that there are no delays or there are no work not happening due to any of that.
Yeah, which is amazing.
I agree. Okay. Publius, we have 3 BFPs that are out there, and I think at least 2 of them are probably worth having a bit of a discussion around. I'll start with BFP 77, which is the curve A factor, or the curve A parameter for the proposed Bean 3-curve pool. Can you maybe take us or give us a quick summary of what does an amplification factor mean, and what does a high amplification factor and low amplification factor mean before we dive into the one that we proposed?
Sure. So the starting point is that there's really 2 extremes in terms of how you can define curve for an AMM. There's the constant product, which is what Uniswap uses, which is X times Y equals K. And then there's constant sum, which is X plus Y equals K. And basically in the X plus Y equals K, what you're doing, if the AMM had that formula, is trading one bean for one 3-curve, or one bean for one LUSD at all points in the curve, and there's no change in the price. And the X times Y equals K is, in theory, you could make it even more volatile, but it is a very natural curve that, in short, has a lot more volatility to it than the constant sum formula. And so what Curve did was, as an innovation on Uniswap's constant product AMM, was they effectively allowed for you to toggle some variation between the constant sum and constant product formulas as some sort of combined formula with which to deploy your AMM. And the A parameter effectively functions as the relationship between the constant sum and the constant product formulas. So a higher A parameter weights the constant sum more, and therefore the price trades at $1 or exactly at whatever it's pegged to for more in terms of size of the trade relative to the liquidity in the AMM. So as the A parameter increases, you're going to have less volatility in the price that you receive in the AMM. And as the A parameter decreases, you're going to have more volatility in the price on the same size trade.
Okay, so let's talk about 2 scenarios now. One which is a high demand for beans, and another one which is during a sell-off period. What would a high A parameter do in each of those cases?
Well, it's hard to answer that in short form because it would likely do a lot of things, and what it would do would only be in comparison to other A parameters. But in short, the higher the A parameter, at the same amount of excess demand or excess supply of beans in the pool, the price would change less. So in terms of the price of a bean at any given ratio of beans to non-beans in a curve pool, the price that you will receive for trading against that pool, despite the imbalance, is closer to the peg as the A parameter increases. So in practice, what you may have is the bean price trading closer to the peg while there is a significant imbalance in the pool. And that has been the case with MIM for a significant period of time. You can look and see that because they have a high A parameter in their main curve pool, the MIM3 curve pool, there is a significant amount of MIM in the pool compared to 3 curve, but because of the high A parameter, the price is pretty close to $1. It's not $1, but it's pretty close to $1. And so the real function of setting the A parameter properly is a question of how much volatility in the bean price is acceptable. And the reason, or one of the reasons why MIM isn't at $1 is because of the friction around AMM fees. And the fact that you have to pay a trading fee makes it such that it's not actually a perfect ARB to ARB the price back to $1. It's only effective to ARB the price back to close to $1 once you consider the fee. And that's one of the reasons why the pool hasn't rebalanced to par or to closer to par. It's because of the high A parameter in the case of MIM. So the arbitrage that you would expect to make money from returning, effectively conducting the arbitrage where you're redeeming assets for the MIM for the underlying assets, which in theory are worth at least $1, that arbitrage isn't profitable because of the fact that there's transaction fees, and that's why the pool hasn't rebalanced. So in the case of properly setting the bean A parameter or the Beanstalk A parameter, I guess it's probably the bean 3 curve A parameter. Let's just leave it at that. The question is, well, how much volatility is acceptable in the bean price? And this obviously relates to, in the case of peg arbitrage, converge. And when you consider that one of the goals of Beanstalk is to incentivize a high amount of conversions within the silo to regularly cross the bean price above and below the peg, it's one of the main considerations to probably be almost counterintuitively, while you'd expect a high A parameter to result in a lower volatility in the bean price. When you think about the health of the system, even though it's a stablecoin protocol, it's probably more likely that a lower A parameter is healthier for the system because it will facilitate more cost-effective converts. And therefore, you're more likely to have oscillations above and below the peg, which is the goal of Beanstalk, as opposed to having beans very close to $1, but consistently above or consistently below $1.
Okay. Maybe I can close the discussion around this proposal with one more question. So Curve has one A factor that goes for the whole pool. Uniswap V3 more or less allows the participant to choose, how concentrated they want their liquidity to be in the pool itself. One way to do this would also be, for Beanstalk to natively allow people to choose when to convert as well. Where do you see the future of convert going? Would it be something similar to, a pool that's like Uniswap V3, where then participants just choose how concentrated they want their liquidity to be? Or would it be something where we, choose when to convert or like an auto convert at a certain price?
It's a very interesting question. And it's worth noting that one of the primary, maybe I should say one of the principles of Beanstalk's design is that users are the ones that decide when to act, and that the protocol, as minimally as possible, tries to minimize the amount of open market operations that the protocol ever makes. And in general, having some sort of automated convert functionality or some sort of order book on the converts, that's, I mean, the order books, some sort of like Uniswap V3 style, because you think about a Uniswap V3, it's really you're bidding on an order, you're bidding on a curve. So you're placing orders on a curve. The concept is you could probably mimic something within the silo where people can say, I'd like to convert at a certain price. Yeah, that's probably reasonable to do, but at the same time, you want to minimize the extent that that's gameable or arbitrageable and taken advantage of. So I don't know if that in practice would go against the principle of the protocol not taking any actions. In theory, now the user is setting the bids, but the question is in terms of execution, is it being executed in a way where the protocol is losing, paying some sort of market maker every time? So that's what you want to avoid. But the assumption has always been that other protocols are likely to build things on top of the silo, and they'll likely handle converts in various different fashions. So convert is designed to be a base functionality such that assets within the silo can be moved around with minimal friction. But beyond that, how participants want to structure their silo exposure over time, that's a very, very open question.
I agree with you. Convert is arbitrage, and to each their own strategy, I guess. Okay, let's take some questions here before we go to the second proposal. Harry Smith asks if there are any updates on the audits.
Let's see if Publius is around to hop up, as they've been communicating mostly with the auditors.
I think not. But the latest update that I know of is no updates.
Yeah, hold on. We'll see. Maybe not. I think that's where I invited up the wrong Publius, so never mind. I'm not sure where they are.
All right. Austin asks, why open market operations at the protocol level are not desirable?
Well, the main reason is that the protocol can be arbitraged. So to some extent, let's say Beanstalk is at the protocol level willing to buy beans at 99 cents and sell them at $1.01. Like in theory, that's great, except in practice, that's going to facilitate some market participants to take advantage of the protocol, where they're basically, there's no risk in holding the asset because the protocol will buy it from you at the lower price, and then there's no risk to shorting the asset because the protocol, you can sell it back to the protocol at the other price. So just when it comes to what the protocol then is doing, the protocol is basically taking the other side of arbitrary market operations with a spread, and that's how you bleed out at the protocol level. So in general, you really don't want to have Beanstalk being the facilitator of that, and particularly when you think about what it is that prevents that from happening in general to participants in the system, it's the randomness associated with when people convert, when people buy, at what prices people buy and sell and convert, and therefore it's not easy to game and take advantage of, particularly when you have a more sophisticated economy built on Beanstalk with derivatives and such. If you have at the protocol level some sort of guarantees that the protocol will buy at a certain price and sell at a certain price, that's going to be taken advantage of.
And I think this is a main differentiator between other protocols that have, let's say, a protocol on liquidity, and then they have rules on what to do when. But Beanstalk then it provides an ecosystem where it allows the market participants to react or do these actions. Is that correct?
Yeah, I mean, we've been trying to look into a little bit more closely how Frax actually implements their AMOs, and have not had a lot of success at getting to the bottom of that at the technical level. But in theory, they seem to be profitably performing market operations, which is it's fascinating. So the question is, how are they actually implementing it? So we never like to say things are impossible because people tend to innovate and build cool shit. So just to say that from a principle design, Beanstalk assumes that it can't efficiently operate on the market. And the only time Beanstalk does operate is during a season of plenty, which, according to one of the proposals, is now being renamed a flood. The protocol dumps beans on the market. And the concept is everyone should front run the protocol and sell, in which case the protocol wouldn't mint any beans. So the only way that Beanstalk is selling beans on the open market is if no one is willing to sell whatsoever. So those cases are very rare, and therefore it's unlikely that a flood happens in most cases. But that's the general concept, is to minimize the amount that the protocol is acting because it can be taken advantage of. But clearly Frax has some sort of innovation in terms of execution.
And would you say the season of plenty is there to maintain peg, not to profit? So, it doesn't do that because it sees a profitable opportunity. It's there to maintain peg.
Correct.
Okay. Betabine follows up on the earlier question about contributors' compensation and asks, will beans be ripe or unripe?
Again, it's not really up to us per se, or at all. I think Beanstalk Farms does have something like 2 million unripe beans, and then any I guess ripe beans or normal beans, whatever you want to call it, that would have to be minted via a noob DAO proposal. So unclear at the moment.
Okay. We've reached the end of the questions. If anyone else has any questions, just write them at the town hall chat. Let's go to BFP 78, which is the minting schedule upon replant. So what BFP 78 says that upon replant, the minting capacity is going to be at 0%, and that's going to increase by 1% per season for the first 100 seasons until it reaches full capacity of 100%. Why is that logic put in place, or what's the thinking behind this?
So there's a couple things. One, any season with an unpause, the price, the delta B is 0, and therefore there shouldn't be any minting the first season or until the start of the first season, and the Beanstalk really mints at the end of the season. So the question is, at the end of the first full season, how many beans should be minted? And it's worth noting that the protocol had a delta B of like 5 million or so at the time of the attack in terms of a shortage of beans in the pool. And let's say the protocol relaunches with the $10 million in change that it has right now, which is something like 13% of the total. You're talking about a delta B in the pool of $550,000, 550,000 beans. And the concept is that you really wouldn't want the protocol to start minting 500,000 beans a season, given that in reality, there's not any ability to sell, right? Because when the protocol restarts, all of the recapitalized liquidity is going to unripe assets that cannot be recovered, or I shouldn't say it cannot be sold, right? If you chop your unripe assets and take the underlying and you sell it, the amount that you're going to receive at the beginning is 0%. So there's not going to be any pods harvestable until the end of the first season. So the concept is there's no sell pressure until the first season. And if the first season there's 500,000 beans of sell pressure, I think the punchline is that it's unreasonable to expect the market to be that efficient, where after 1 or 2 seasons, the whole thing will reprice itself and the minting will go towards whatever the actual number of beans that need to be minted or soil that needs to get minted. And allowing that to play out over 100 seasons and gradually scale up over time is a much more conservative way for the protocol to replant. So I guess the original idea came from the fact that when generalized minting was going to go live and minting based on the Bean 3 curve was going to go live, a similar effect was in place because it was a 5 million delta B effectively in the pool, or close to it. Most of the delta B was from the curve pool. And so the concept is you can't just go from minting X to minting 10X. That's a crazy change. So you got to scale things over time. And that applies to generalized minting, or it would have applied to generalized minting, and how it would have made sense to have implemented that. And now, since we're launching a pool, it still makes sense to do that.
Okay, and what's the worst that can happen here? So we're limiting the minting, the maximum output of it. What's the worst that can happen if we have like a sudden, high demand and we're not minting enough?
Yeah, I think that's the only risk, right? Is that there's excess demand for beans, and the protocol isn't minting enough beans to return the beans to the peg. But that is that's like it's a great situation if there's excess demand for beans to that extent. But B, it's not a problem for Beanstalk, and particularly given that it will have a scaled minting schedule. If the minting doubles or triples or quadruples, it won't have any effect because the minting is still being scaled. So the concept is you allow over 4 days the market to price itself, and maybe beans are worth $2. Maybe they're worth 50 cents, but you got to allow the market to price itself over time. And given that the minting schedule would really only affect the supply side, the risk is that the bean price pumps too high. And given the way that the unripe assets will still be able to convert, for example, and you will have fertilizer being paid back and pods being paid back as the minting schedule increases, there's no reason to expect that sufficient supply to return the bean price to $1 won't be minted over time. And it is worth noting that since the protocol is going to start at 500,000 beans or so above peg, let's call it that, you can't have it minting 500,000, 500,000, 500,000, 500,000 for like a day, and then the price collapsed to 80 cents. That's so to some extent you risk the price going higher due to the minting schedule that increases over time, because you risk potentially inorganic demand catching hold in the early days, but you'd really expect it to turn into mostly demand for fertilizer, particularly over those couple of days while the minting schedule is scaling up, as opposed to turning into demand for beans. So it's not exactly, it's just, you have to play out what is actually realistic, and it seems like the safer course of action when evaluating how likely it is to have the system overprint upon replant, it's much more likely to overprint if you start at 100% likely.
And it's a problem that will solve itself anyways with every hour. So with every hour it gets better, or it diminishes the problem for 100 hours. Okay. That summarizes both BFPs 78 and 79. We also have the last one, which is a change in terminology. All of these are up for voting. I'm actually not sure if the last one is, the terminology one is up there. That's not yet. But the other two proposals that we discussed, which is the A factor and the minting, are out there for voting till July 1st. All right, Publius. We have discussed this recently a bit, and there is a continuation of that discussion, which is about the Bean ETH pool, and then the possibility of allowing a convert between those pools. Can you take us through the thinking right now? What are we thinking about this? So replant, then Bean ETH, then what?
Well, there's a lot of different questions, right? And to some extent, the liquidity pools, let's just answer the liquidity pools exclusively for now. And we can talk about what else makes sense to put on the roadmap for after a Bean ETH pool. But just thinking about what other pools it makes sense to whitelist over time. So there's two different functions that a pool really has in the case of Beanstalk, or that it can have. One is as an oracle for a US dollar, and the other is as some sort of exogenous source of value. And Ethereum, as we're all seeing or being reminded of once again, is very volatile. And while Beanstalk launched with a Bean ETH pool and lived and died by the early ETH volatility, it was certainly a pain in the ass in the early days. And as the Bean 3 curve pool grew in magnitude relative to the Bean ETH pool in terms of liquidity, the effect of the Ethereum price on the Bean price decreased, which was great for stability and for efficient price discovery. Now, at the end of the day, though, the problem is that 3 curve is largely centralized, and USDC and USDT are centralized, and then DAI is largely backed by USDC, which is centralized. And so, unfortunately, it's kind of a deal with the devil, right? Any of the exogenous value that Beanstalk accrues in liquidity pools that is in the form of 3 curve at some or any point could be rugged. And that's a major issue when you think about the short-term stability of the Bean price. And while you have ETH volatility that affects the Bean price, it's hard to say that some volatility is better than an all or nothing. Like, it's very clearly that some volatility is acceptable and or preferred as opposed to all or nothing. So the Bean ETH pool is very important. Then you think about what other value is decentralized and less likely to go straight to zero. It's either a 1 or a 0. LUSD is very interesting, although the amount of exogenous value you can have from LUSD is very correlated to the Ethereum price and limited by the Ethereum market cap. So if you're looking for exogenous value in size, it's sort of hard to know where that comes from, particularly if you're looking for decentralized exogenous value. So this is one of the, I think when you take a big step back and look at the major philosophical questions to answer about Beanstalk, it's where does exogenous value in size come from to provide liquidity for beans, and how to make it such that the exogenous liquidity available scales with Beanstalk. And I think you could make the argument that at real scale, the Ethereum price starts to be really affected by demand for ETH in these liquidity pools, and therefore the exogenous value can scale. But that's a highly, that's a feedback loop that can unwind very quickly. And if you have the interest rates on beans that are causing there to be demand for ETH, when you have short-term interest rates for beans decrease, that's going to decrease the amount of desire to hold ETH to receive those interest rates, and that's going to cause a decrease in the price of Ethereum, again, assuming this is all its size. And that creates a negative feedback loop whenever that starts to unwind, and that's what you really want to avoid. So the question is, how do you both minimize your exposure to Ethereum and minimize your exposure to centralized stablecoin options as more stable sources of exogenous value? These are, there's a couple different ways to go about answering it, but they're all, at this point in time, imperfect.
Yeah, thank you for that answer. I have a question that's more evolved around what's happening in the overall DeFi space right now, and we're seeing that a lot of markets, or a lot of let's say entities are having a challenge, which is mostly attributed to leverage or high leverage. And we've had, a lot of people didn't think that prices would crash, this low, and many of them got liquidated, and this liquidations, caused a further spiral down. and we would say that most leverage comes from, what we would think speculation or driven by inorganic demand. The thought that, this is going to, come up with more and more and people get leveraged on that. What can Beanstalk do and we do this already by not incentivizing inorganic demand, but what can Beanstalk do to limit or inhibit that speculation, let's say, and is that even possible? Do you think Beanstalk can even do that?
So you can't limit the speculation, but what you can do is minimize by design or in practice the amount of the demand that is speculative demand. And so what else is there other than speculative demand? And that's one of the reasons why you're seeing so much unwinding happening in the current state of DeFi. It's because it was basically all leveraged speculative demand. Well, Beans and the interest from Beans currently is all from speculative demand. The interest that you receive is from people buying Beans, and the reason they're buying Beans is because of the interest rate. And to some extent, it is very important that in the early days, Beanstalk, in order to establish Beans as money, works without having any real economic activity happening within the system. And it first establishes that the model at its core works purely from incentives. But, and this is a big but, excuse me, in order to move away from just a purely closed speculative system, you do need to start to have real economic activity happen within Beans. And given that the main attraction of holding Beans and using Beans is the interest rate for holding them in the silo, it's highly likely that that economic activity is going to happen on top of the silo. So betting markets on top of the silo, to me, stands out as the biggest potential real economic activity that can happen in the short term on top of the silo. And over time, as Beans become more stable, it's very possible that trade and commerce start to be denominated and take place in Beans because of the ability to receive yield and the stability in the bean price, which makes it a very attractive currency to use. But you got to start somewhere, and it's likely that the exogenous demand or the real economic activity that is organic, let's call it, and not from just and we've used organic and inorganic demand differently. But let's talk about demand to use the beans for economic reasons other than just holding them in the silo. That is likely to decrease the amount of speculative demand as a portion of total demand, if that makes sense.
Yes, and I'd like to follow up on this. So we said there could be two reasons for demand for beans. One is speculative, and then the other one is to use it, as a stable coin or use it as a store of value. Do you think it makes sense, and I'm thinking loud here, that let's say, if the price of bean is above 1 for a certain period of time, then any new demand that comes in doesn't get seigniorage or gets less seigniorage for a certain period. This allows the use of bean as as a medium of exchange or a sort of value, but not so much attractive anymore for speculation.
So first, I just push back and say you can also have beans used as a medium of exchange, and perhaps one of the cool things about beans in the silo is that they're both a store of value and a medium of exchange, and they're stable in denomination and accrue interest, which makes them very unique. Now, in terms of limiting minting to new users or new depositors in the silo, on the one hand, that may create a decrease in inorganic demand when the price is above 1, which is attractive. But on the other hand, it may create some sort of misaligned incentive to keep the price above 1, if that makes sense. Now, it's probably not likely that at the margin any one party is going to have enough of the silo such that it's meaningful for them to keep the price above 1 instead of letting the price oscillate normally in line with whatever the supply and demand is at the time. But if people were around in the early days around the season of plenty, it's very hard to coordinate all of the silo members to keep the price below $1 to reset the range. And that's one of the things that in an efficient market, you really don't want there to be reasons for people to be buying and keeping the price too high, which sometimes plays out because of some sort of rule written to the protocol like that. So we'd have to think a little bit more about it. But if anything, the implementation that of achieving a similar goal that probably makes more sense, although is likely more difficult to implement, is that the beans that are paid as seigniorage are received over time. And so, you receive them over a certain number of seasons. And if you deposit quickly and withdraw quickly, then you obviously receive a lot less of the seigniorage than you would have because it's paid out over time. But multiple ways to skin this cat.
Okay. There's a question also in the economics channel, and this is something that we've discussed, but maybe you can give us a summary a bit of it, which is, again, what does positive carry mean?
So positive carry is the cost to holding a position. Well, I should say carry is the cost of holding a position. And so positive carry means that you get paid for holding the position, which is the case for beans that you're holding or LP tokens that you're holding in the silo. And the concept is that being long beans or holding exposure to beans comes with some sort of payment in the form of bean interest, so you're getting paid for holding the position, which is positive carry.
So would you say that it is, depending on a currency that you can have, if the expansion of it increases, who gets paid for it? Would it be something as such? So let's say I'm holding some USDC, and then the market cap of that it increases, then there is a cost for me to holding it that I should have or could have done something with it. And I don't get any of that growth of it. When on the other hand, having something such as the silo or the seigniorage-based system, those who are participating in it are the ones that capture the growth of it. And this is where the positive carry comes from. So who gets paid when the currency is basically used?
Well, I think we might be mixing a couple different concepts here. Where the carry comes from, that's an interesting question in and of itself. In the case of Beanstalk, it obviously comes from bean seigniorage, which is inflation. But unlike another protocol like Ohm, for example, where you could make the argument there's positive carry because you're getting paid tokens to hold the position, the payment of the carry for holding the position is independent of the price or the value of the position. And so you're actually taking a trade on the carry relative to the change in the underlying, which I guess is the trade you're making in every case and also in the case of Beanstalk. But because beans are only minted when the price of a bean is above $1, there's some expectation that the seigniorage that you're paid is interest as opposed to some sort of financial outcome that either you won the carry trade or you lost the carry trade because of the change in value of the underlying. So because the bean seigniorage comes by rule only when the bean price is too high, you can, and again, it's just different ways of thinking of similar things that are happening, but the interest that you're paid or the carry for holding the position that you're paid only comes about when the value of the underlying is stable. So you could make the argument and there certainly is still risk in the price of the bean changing, and that's the risk of the trade relative to the carry that you get paid for in terms of being seigniorage. But I think the classification of it as positive carry is fair, given the fact that you're receiving the interest by rule only when the price is too high.
Okay, thank you for clarifying that. Salon asks, what is the upper bound on the replant timeline? Do we have a deadline that we have to restart there, or
no upper bound? I think everyone is working as hard as humanly possible to make sure that once the audits are complete, there's no additional issues. Obviously, the goal is to replant properly and without any major hiccups. And so however long it takes to get to the point where that is the case, it'll take what it'll take. Certainly don't think that this will push us into like something crazy like Q4, but and let's say this sort of ad absurdum. If it took that long, it would. But betting obviously the heavy under that hopefully sometime in July we'll be able to replant this bad boy. The protocol was launched originally on August 6th, 2021. It would be painful for us if the 2022 launch was after that. So not a strict upper bound, but that's still five weeks away or so. We would certainly hope it would be before that.
A mental upper bound. Amir Hodlberry asks, what's the team's thoughts about regulatory risks and what the response might be when the pressure comes?
Well, there's always going to be risk in terms of the effect of the bean price and the risk of holding beanstalk assets if, for example, governments decided to make holding those assets illegal. But that aside, or maybe another risk would be the operators of USDC being forced to blacklist the USDC ETH Uniswap pool or the 3-curve pool. Those types of things certainly pose risk to Beanstalk in terms of how the protocol currently functions, but not existential risk because the protocol could change and react and derive its price from other places. Even if the peg may be slightly less accurate, you can get a decentralized price for $1. In almost all cases, the question is really what is the likelihood that any of those issues to USDC happen, or, for example, or in a more extreme case, people are banned from holding crypto assets or Beanstalk assets. But that aside, Beanstalk doesn't really care. So Beanstalk is a piece of software that exists on the Ethereum blockchain and is autonomous. So upgrades to the protocol, unfortunately, currently aren't fully permissionless and autonomous. But other than that, there's no reason for the protocol to change and implement things that the government would want it to implement. The goal of Beanstalk is to be totally free from any. I guess the government could. It's a proof of stake system, so the government could buy enough stock to implement BIPs that would enforce certain laws that they wanted enforced. But that aside, there's no way for the government to impose these things on Beanstalk. So Beanstalk is designed to be resistant to any sort of regulatory pressure of any kind.
Amir Hadlberry asks, KYC AML pressure, and same answer.
Yeah.
Okay, I think this is the end of the questions. And what I also had in mind to discuss. So we can give it a minute if anyone else has another question or someone wants to come on stage. Otherwise, we can call it class. Okay, Publius, always a pleasure. Thank you for taking the time, and see you in next week's class.
Thank you, Mad. Talk soon.
Bye-bye.